Welcome to The Explainer. Let's jump right in, shall we? Today, we're opening up the strategic playbook of Cimpress. Now, if you've ever ordered custom business cards from VistaPrint or, say, some promotional pens from National Pen, you definitely know their work. They are the global leader in web-to-print mass customization. But today, we're not just looking at what they print. We're looking at exactly how they operate on a corporate level to generate value. We are going to map out how this company is actively positioning itself for the future.
So you gotta wonder, which brings us to the central question driving our explainer today. How does a global web-to-print giant actually fuel growth in a maturing market? Because let's be honest, mass customization isn't exactly a brand new frontier anymore. There is intense competition out there. So for a giant like Cimpress, keeping that growth engine going requires pulling multiple, really complex levers all at once. Everything from internal accounting shifts to massive external acquisitions. Let's anchor ourselves in the financial reality right out of the gate with a specific number, $95.50. According to recent analyst consensus data, this is the current Wall Street price target for Cimpress stock. Now, compared to a recent trading price sitting around $89.61, that $95.50 target represents an expected upside of about 6.5%. But how exactly do they get there? What are these analysts seeing under the hood? Well, here's our roadmap to figure that out. We're going to hit 1. The business snapshot, 2. Bulls versus bears, 3. The CEW deal, 4. Capital allocation, and 5. The FY 2028 horizon.
All right, Section 1, the business snapshot, surpassing expectations.
Looking at their baseline financial health through their Q3 fiscal 2026 highlights, things are looking pretty strong. They reported a 12% overall revenue growth year over year. But here is the absolute standout metric. EBITDA surpassed $100.5 million. That is literally the first time they have ever crossed that threshold in a third quarter. And because of this incredibly strong performance, management actually went ahead and raised their full-year FY 26 guidance. They're now targeting 9% to 10% revenue growth and bumping up adjusted EBITDA expectations to at least $465 million. And what's absolutely crucial to remember here is that they achieved all this and raised guidance despite having to factor in rising energy and oil costs.
When you break that growth down across their major brands, you see their core engine, VistaPrint, delivering a really solid 7% growth. National Pen is right alongside it with a 10% increase. But take a look at Print Brothers on the right, a massive 30% jump year over year. Now that incredible spike for Print Brothers isn't just organic growth. It's heavily fueled by their recent strategic acquisitions, like taking an 85% stake in the Spanish print business, Trio. It just goes to show how targeted M&A is actively moving the needle for their top line.
Moving on to Section 2, Financials Bulls versus Bears.
Let's look at the push and pull dynamics here side by side. On the bull side, analysts are quick to highlight the strength of the core VistaPrint customer. Variable gross profit per customer actually grew by 9% year over year, hitting $75.90, alongside a really solid 11% increase in overall quarterly revenue. Basically, they see a business squeezing more profit out of a loyal customer base. But if we pivot and look at the bear case on the right, the main concern centers around product mix and margins. Overall gross margins actually declined to 46.7%. Why is that? Well, customers are shifting towards lower margin products, while demand for high margin legacy items, like those traditional business cards, is stagnant or even declining across the whole mass customization sector. So the key takeaway here is that investors are actively weighing this increasing overall revenue against the margin pressure from shifting consumer habits.
Next up, Section 3, M&A, the CEW deal.
So, Cimpress recently signed a definitive agreement to purchase the commercial online print segment from CEW. This package includes two major brands based in Germany, SAXOPRINT and viaprinto. This is what you'd call a classic tuck-in acquisition for their Print Brothers segment. It's perfectly designed to significantly expand their manufacturing capabilities and their market footprint right in the heart of Germany, specifically serving high-volume business customers.
Let's break down the actual deal metrics, because the math here is fascinating. These target businesses generated almost 90 million euros in revenue in 2025, operating with an EBITDA margin around 10%. But here is what you really need to take away from this. Cimpress's net cash outflow for this acquisition is expected to be under 80 million euros after anticipated asset sales. Because of that relatively low upfront cost, combined with the massive planned synergies across their European production hubs, Cimpress expects a base case return on capital well in excess of 20%. And honestly, that is a highly favorable projected return for a strategic buyout.
All right, on to Section 4, Capital Allocation and Debt. $200 million. The Cimpress Board of Directors recently authorized a massive new open-ended share repurchase program for up to $200 million of its issued and outstanding ordinary shares. Now, when a company buys back its own stock, it reduces the total number of shares available on the market, which can fundamentally increase the value of the remaining shares. And what's really interesting here is that this specific authorization has no expiration date whatsoever.
In their filings, Cimpress noted they might execute these buybacks on the open market, through private transactions, or potentially via a self-tender offer. If you aren't familiar with the corporate jargon, a self-tender offer is essentially when a company directly asks existing shareholders to sell their shares back to the company, and they often do it at a slight premium to the current market price. It's a very direct, very intentional mechanism for deploying that $200 million.
But, and this is a pretty massive but, that $200 million stock buyback is absolutely not guaranteed to happen all at once. These buybacks are heavily constrained by their net leverage goals. They are constantly playing a game of balancing rewarding shareholders with managing their debt. In fact, they literally just closed a massive new $1.1 billion term loan B. This new loan pushes their maturity date way out into the future to 2033, and it's set at an interest rate of SOFR plus 2.50%. So the management team is effectively walking a tightrope, returning capital to shareholders only when their debt levels and operating cash flows comfortably allow for it.
Now, take a look at this. It might just look like a boring accounting document at first glance, but trust me, it's actually a hidden strategic weapon. This is their recent guide to reporting changes. They recently updated their internal accounting rules, specifically regarding how different segments of Cimpress charge each other for services.
Let's cut through the corporate speak here. Imagine one Cimpress brand, let's say Vistaprint, wants to use a Cimpress-owned printing facility to get a job done. How do they handle the cost internally? Well, under this new methodology, Step 1, the merchant business is only charged the variable costs. We're talking just labor, materials, and shipping. They completely remove the old fixed overhead charges. Step 2, the fulfilling facility then receives those variable costs back, plus a specific markup multiplier. And Step 3, while the profit stays on the individual segments' books to reward their performance, it's totally eliminated when reporting the consolidated overall company financials. Why does this matter so much? Because by removing fixed overheads from the internal price tag, Cimpress is financially incentivizing its own brands to use Cimpress's internal printing hubs rather than outsourcing to outside vendors. It's just a really elegant way to drive internal efficiency and scale.
Finally, Section 5, the FY 2028 Horizon.
There's a quote right from their CEW acquisition press release that perfectly summarizes their ultimate dual mandate right now. They intend to, quote, execute against our previously announced FY 2028 financial targets without changing our established plans to meaningfully reduce net leverage over the next 2 fiscal years. It really is a delicate tightrope walk. They want the aggressive growth and efficiency by 2028 for sure, but they absolutely must pay down their debt along the way to get there.
Which leaves us with this final, really provocative thought to take away from this explainer today. Can Cimpress seamlessly balance debt reduction, massive share buybacks, and external M&A to actually reach those FY 2028 targets? They are definitely pulling all the right strategic levers, incentivizing internal production, making high-return acquisitions, and giving themselves the flexibility to buy back stock. But at the end of the day, flawless execution in a shifting consumer market will be their ultimate test. Thank you so much for joining me on this explainer, and I hope this really helped you map out exactly what's happening behind the scenes at Cimpress.